Welcome back to Miller Momentum. I'm so glad that so many of you enjoyed my 2 ETF portfolio video that critiqued Professor G's strategy. Going forward, though, I believe I can express my concerns in a more positive way. You win more bees with honey, right? And besides, karma repaid me with an ingrown beard hair on my lower lip. I won't bring it too close to the camera because it's kind of gross. But anyway, oops, my apologies. So, I hear that if you're going to talk about stocks and investments on YouTube, periodic portfolio updates are basically mandatory, but I'll do you one better. Here at Miller Momentum, I believe in absolute transparency. I want you to know that I have skin in the game and actually invest in the strategies I showcase on this channel. That's why you can now track my public portfolio in real time always from the convenient links on my channel homepage. You can see the prehistory too, when I didn't follow these strategies, all the way back to the beginning of my public choice retirement account when I first went out of my employer's target date fund and started experimenting around, including with the infamous 3 ETF YouTube portfolio, I'm afraid to say. Uh, I've learned a lot in these past few years, mostly self taught. I started questioning when I joined communities, and I just built my knowledge and made sure that I believed in my investments and that I was solid in my knowledge about how things work. So let's talk about it. Let's talk about my most recent shift from the Miller Momentum flagship portfolio, which I strongly believe in, to the Atlas portfolio, which is the new name for the Immortal portfolio, basically because, well, I think Atlas is a little bit more descriptive. It gets at how the Immortal portfolio invests across all of the different asset classes. So I like Atlas because it's kind of like the whole globe. Let's talk about it. But first, a quick disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. Now, it will come as no surprise to you that I strongly believe in all the strategies I showcase on this channel. Otherwise, why would I showcase them? In analyzing them, though, you may also realize they align with all or parts of four basic portfolio frameworks. And to make this evident, I'm going to put the frameworks right up on screen. For example, the Dragon Rider portfolio is the Atlas portfolio with more equity and managed futures layered on via return stacked or capital efficient funds. The 2 ETF fund portfolio with SPMO and VBR, or MTUM and AVUV, depending on preference, is the equity portion of the Zenith portfolio. This is no accident. But just because I am convinced of these four frameworks doesn't mean all of them are for me personally. Don't get me wrong. I'm very proud of all of them, and I think that they will work out very well. But the Atlas portfolio aligns best with what I've learned about my risk profile and my preferences. I like its normally distributed behavior and steady compounding. And I like the fact that it invests in so many alternative assets that, in my opinion, don't get enough attention. I like having a smaller equity holding portion and still getting equity like returns. Maybe it's just the contrarian streak in me, but it's my preference. Let me show you what I mean, though, about its normally distributed behavior and steady compounding, and why this really appeals to me for a retirement portfolio strategy. So I've got my four core Miller Momentum strategies up on screen, and I've loaded in my preferred ETFs and funds for each of them. And you can see that over the past 12, 11 years, they've done very well, and they've done very comparable to one another for the most part. But what really attracts me to the Atlas portfolio is that its longest drawdown was only 1.49 years. It has the lowest volatility, highest Sharpe ratio, and it tends to continue performing well when the going gets tough. So I really like to have good returns during times when the market is struggling. And personally, I'm willing to give up some performance during bull markets to have that extra sense of security during hard times. You can really see this when you switch to the rolling metrics. So, when the market started hitting very volatile and weird and uncertain times in 2022, the other strategies petered out a little bit because of their reliance on larger equity portions, whereas the Atlas portfolio continued to perform well and eventually overtook the other strategies here. We can actually look and see what the Atlas portfolio did on a much longer time scale than 11 years or 12 years because I've got the back tested series data loaded into testful.io, and testful.io also has some really good history on its tickers where it can apply the strategy of modern funds back in time because we have all of that trading data, we have all of that stock data, we have the performance data of the assets so that we can actually see how portfolios performed in the past. So let's take a look at the Atlas portfolio here and take it back into the past to 24 years. As you can see, the 60-month compound annual growth rate has always been positive. So when I'm making contributions to my retirement account, I want to know that the money that I'm putting in is growing at about the same rate, right? I want to control my sequence of return risk. And this will be important for when I retire because who knows? I may retire during a so called lost decade, like the year 2000 to 2010, when the market isn't doing well. And I'd rather have a strategy that is more all weather and allows me to draw down reliably than having to put, 2 or 3 years of money aside in cash and just hope that that tides me over until my stock portfolio recovers. That's just my personal preference. There's different strategies and approaches, sure, but I feel like slow and steady and reliable wins the race. That aligns best with my personality. And so if we slap on the S&P 500 and just compare the two here, you can see that the S&P 500 is all over the place. Its 60-month compound annual growth rate from about the year 2007 until 2014 was well below the Atlas portfolio. And right now, the Atlas portfolio has just overtaken it again in this 60-month compound annual growth rate. So I just really like that predictability. And when you look at the returns of these portfolios, the Atlas portfolios return minimum for annual returns was negative 13.87%, whereas the minimum for the S&P 500 was negative 36%, actually almost negative 37%. Now, if we do a Monte Carlo portfolio simulator, which is really great because it takes the returns over the past time frame that you have set, say 24 years or whatever, and randomly samples them and creates a theoretical or hypothetical return profile for a period of 30 years or whatever you specify. Um, if we just, set this to the S&P 500 and compare it to the Atlas portfolio and run this simulation, you can see what I mean by the predictability of the Atlas portfolio really winning me over here. Simulation will take just one moment to run. I'm doing 5,000 simulations over a sample of 30 years, sampled from that 24-year return profile. So we're constructing a hypothetical 30-year time frame to see what these portfolios might return based on their historical returns. We can see that the Atlas portfolio, at its absolute minimum, has a compound annual growth rate of about 2.97% over that 30 years, which just doesn't seem that impressive, but its median is 7.65%. And in 75% of the cases or simulations, it's making right about 6.79%. And this is after inflation, by the way. Before inflation, you can see these numbers are much better. And you may go, that doesn't seem that impressive, but look at the S&P 500. Its minimum over 30 years for a lump sum investment of $10,000 to start would be negative 3.44% after inflation. And its median is 7.82%. And 75% of the time, you're going to be making just about 6% or more. Well, with the Atlas portfolio, 75% of the time, you're going to be making 7% or more. And there's no run in these 5,000 simulations where you actually come out with a negative return on that initial $10,000 lump sum investment. So I've got 60K sitting in a portfolio, say right now in my retirement. I don't want to risk having that grow at only like, you know, 3% or 4.26% in 10% of the cases, the possible futures that we could face going forward for the next 30 years. Again, this is a simulation, it's a Monte Carlo simulation, and I'll do a video talking about the limitations and what a Monte Carlo simulation is and why it's useful for strategizing about investments. But my point is, the Atlas portfolio is really robust. It's giving me comparable returns to the S&P 500 over a 30-year time frame. So the choice seems obvious there. Now, with the other Miller momentum strategies, they do have similar positive returns uh, when you put them through a Monte Carlo simulation, and I will show that in another video. But I really like the Atlas portfolio because it limits the drawdown and the volatility and really excels during rough times. And I tend to, just because of my personality, prioritize preparing for hard times over harvesting good times. And this seems like a strategy that's really going to align with my behavioral patterns in that regard. So I'm trying to, in a sense, outsmart myself, my future self, that is, and anticipate my future behaviors when hard times hit. And I think this portfolio is going to be the one that I'm most likely to stick with given those considerations. But enough with back tests. Let's get into my actual portfolio and my actual holdings and just take a look at it. Now, one of the things they don't tell you when you start investing is sequence of return risks. So, when I first switched from my target date fund with my employer, I went with the YouTube 3 ETF special fund. Um, you know the one. One third in a growth ETF, one third in a value ETF, and one third in the S&P 500. But it's actually just the S&P 500. And so you could see that my investment very closely tracks the S&P 500 up until about June of 2025. And that dip back in April of 2025 really did spook me because, again, I was still learning, still growing. and relatively new to the investment world, and was perhaps a little bit too trusting of some of the things that I saw on YouTube, and too uh, deferent to authority. But then I got a little spooked and I tried a very conservative strategy for a while, uh, modeled on the Dragon portfolio that Chris Cole put out, but with very little equity. And it wasn't growing that much. And so I went back to the YouTube and got caught up in all of the excitement about crypto that was happening in 2025. And so I put 10% into Bitcoin, not proud of it. And it was Bitcoin layered with gold, though, so I thought it would be safe. But as soon as it started dipping, I went back to a more conservative strategy. And I thought back in November 2025, I need to just switch to a bogglehead style index fund until I really figure things out. And so I spent the next 2 months using my free time to just learn academic finance and investing and really immerse myself in it over the Christmas holidays and whatnot. And I just kept my money in a broad index boglehead style fund for a while. And then by the time January rolled around, I had figured out the core strategies that I wanted to pursue and that I wanted to showcase on YouTube to help other people avoid the painful experiences that I went through and get to a investing strategy that actually works for them. And so I put into action the Miller Momentum portfolio, the flagship, in January 1st of 2026. Now, am I worried about the early mistakes that I made when I switched to the personal choice retirement account? Not really, because at this point in my investing journey, my monthly contributions to my portfolio are actually much larger than the gains that it experiences on a monthly basis. So the portfolio's gains are a little less relevant than they would be if, say, the portfolio was larger and its own gains were contributing more than I was. So if you're going to experiment, earlier in the investing journey is probably mathematically better than later when your contributions are still doing most of the work. And I've heard from a lot of people, and I've looked into target date funds specifically, that the shift where the portfolio actually starts doing more of the lifting and you do less is somewhere around 140 to $150,000. So until you get there, as long as you don't get too crazy, um, it's fortunate in my case that experiments will not hurt that much in the long run, as long as you're still keeping even with at least the returns of the uh, global stock market, which over the past 5 years, and I can't display it on the channel because, you know, back then it was in the employer retirement account, so it wasn't in Charles Schwab, and there's no way to link and show you that history. But my compound annual growth rate over the past 5 years has been just a few basis points above that of VT. So I'm fine with that because that is the basic benchmark. I don't believe the S&P 500 is. It's the global stock market that I care about because the US is just experiencing a very long period of outperformance. But, as long as I'm making at least as much as I would have on my default retirement fund, which was a target date fund, which at this point in time is almost identical to VT, then I'm not hurting anything and I'm still good. And again, not investment advice. That's just what I've decided about my situation. When you check out my public portfolio, it's going to be really evident looking at the return charts as to when I switched to the Miller Momentum strategies. And I started with the Miller Momentum flagship strategy, which I've renamed the Meridian portfolio because the Meridian portfolio describes what it does much better. It strikes a middle balance between equity and alternative assets, and models itself after the traditional 60/40 portfolio, but updated so that your alternative sleeve is spread out beyond just bonds, and the equity sleeve takes into account a split between momentum and value factor investing. But it's quite evident. Yeah, I switched to my strategy, the Miller Momentum Flagship strategy, which is now the Meridian portfolio, on January 1st. And it did very, very well so far this year. Now, by the time we get to May, that is when I switched over to the Atlas portfolio because it was up about 15 or 16% for the year. And at that point, I had done a lot more research into my risk profile and figured that the Atlas portfolio would be a better fit for me, and that switching at the top would be much wiser than switching at the bottom. So I went ahead and locked in those gains. And since then, I've done very well compared to the S&P 500 here. I mean, I'm about neck and neck with it year to date. I don't anticipate being above it for the whole year, especially if the current bull run continues. The point of the Atlas portfolio is not to beat the market during a bull run. It's to actually hold on to the wealth that you gain and not lose it during a bear market. And that's how it eventually gets its edge, and at least over the past 24 years, ultimately overcame the S&P 500 in total return. I just like that slow and steady philosophy. So, do I have any changes or updates to the portfolio in mind that I might do in the future? After consideration and discernment, and I made a community post about this today because I had some time around my lunch break to do some analytics and finish up some analyses that I had been running about looking into perhaps using AVDV or AVUV or some combo of the two cap value funds to replace AVGV. And I decided against it because the math really didn't support it, and simplicity is a virtue. And I didn't want to sacrifice any of my cat bonds to take on long treasuries as a hedge because, I mean, this portfolio is already protected enough during bad times. The hedge just didn't seem like it would be worth it in terms of the opportunity cost that I would miss out on with the steady compounding for the cat bonds. So I don't anticipate this portfolio changing much for quite a while. The one major change that I would make, if I could, would be to substitute GDE, the US equity and gold return stacked fund, with a global equity and gold stacked fund. So maybe return stacked will come out with RSSG, one can hope, but that's the only change that I really anticipate on the horizon for my personal retirement portfolio. I satisfied my concerns over overlap between AVGV and the US equity portion of GDE. Uh, because of AVGV's value focus, the overlap is actually quite minimal, as you can see from the chart that I've put up on the screen. So I'm not really bothered by that. And besides, the ultimate goal here is that I'm going to be holding VT global equities in that return stacked allocation with gold. So at that point, um, overlap is kind of the idea. AVGV exists to tilt that other global allocation toward value and double up on some of the value names, so to speak. I mean, it's not going to literally double up on them, but you get the idea. It's going to add more weight to the value stocks within that VT allocation, and it's going to tilt toward small caps because that's what Avantis does. That's their whole methodology. Speaking of the portfolio and why I didn't go into just small cap value, after running analyses, I just figured it really wasn't worth it. Let me show you the back test that changed my mind and convinced me that I need to just embrace simplicity and stay with AVGV. Now, we can't extend the Swiss Re cat bond index back past about the year 2000 because it just started collecting its data around that time. But what we do know is that intermediate treasuries during the 90s did very well and had very low volatility and behaved a lot like cat bonds. So we just extend that series using IEF, for which we do have data going back then. And we can extend AVGV back before the simulated version that was created for it to kind of backtest the strategy, DFGV sim, and just substitute VT to fill in the background. Because, I mean, that's the conservative assumption. The value portfolio typically beats the global approach. So if you just substitute the global approach, it gives you a conservative estimate, right? And the two other alternatives to the Atlas portfolio allocations I decided on that I was considering, and these two alternatives still adhere strictly to the portfolio framework for the Atlas portfolio. So these frameworks can be adapted quite a bit to individual needs. But the first one was to split AVGV into US small cap value and international small cap value. And then the other option I was considering is to do option two, but also split up my cat bonds so that I had 10% in extended duration treasuries, right? Well, when I ran the numbers, though, assuming monthly contributions, they're basically identical after 31 plus years. So why go through the extra complexity and pain of having extra tickers and all of that extra strategy stuff? I mean, the max drawdowns, the volatility, the longest drawdown rate, it's almost unchanged for all of this. And if you look at the rolling metrics, it's basically the same. They oscillate around the same middle part. They all have this beautiful normal distribution in terms of their 60-month compound annual growth rate returns. You can see that it's hard to see these three lines up here, but their median 60-month compound annual growth rate returns are comparable. You've got 9.72%, 9.59%. 10.17%. So just why? Why the extra complexity? If four ETFs can get you where you need to be, well, why add a fifth? Thank you so much for watching Miller Momentum. If you enjoyed this video, hit that like and subscribe button. What is your 2026 investment strategy? Let me know down in the comments. I plan to do a special video for each of the four core Miller Momentum frameworks, so also tell me which one you'd like to see me do first. I'll see you soon.